Welcome to Navigating the Forks in the Road, a presentation examining the many crop insurance and revenue protection choices farmers make as a series of forks in the road, and discussing how to avoid a dead-end fork. This presentation is part of the Education and Outreach Partnership between the University of Delaware Extension and USDA Risk Management Agency. Extension does not sell crop insurance. This effort is about raising producer awareness of crop insurance and revenue protection options. The New York Yankee great catcher and outfielder Yogi Berra once said, "When you come to a fork in the road, take it." As regards agricultural risk management is never ending. Each decision inevitably leads to another one. Many decisions are irreversible and the consequences can be significant. That is why risk management needs to be at the forefront of our thinking, especially in the off-season when the planning execution takes place. For Delaware and Delmarva, crop insurance and revenue protection products and options have never been better or more relevant, and making the right choices for your operation is essential. It's important to know the options before us as best we can so that we can make the choices fit for the operation. Today we talk about risk management forks, including how we do market analysis and we plan for the coming crop, deciding which acreage is going to be planted to which crop, whether we obtain crop insurance or revenue protection on some crops, all crops, or if we essentially self-insure by taking no crop insurance. We have to decide on what type of coverage to take, whether it's yield, revenue, or whole farm, or some kind of combination. We have to decide on coverage levels, and we need to think about matching that coverage level to our actual risk. And other things to consider are the unit structure for the coverage and the cropping practice. Planting is an annual ritual. Where do we plant? What do we plant? We look at the markets. What are the markets telling us? Where is the profit? If we grow fresh produce, what do our customers want? If it's grains and soybeans, what are the markets telling us? What's the stocks to use ratio, etc.? If we grow vegetables for processing, what are the contracts offering? What does our crop rotation require in our planning? What crops are we going to irrigate? Which crops can withstand a non-irrigation practice? Do we have fields where weed or disease pressure is prevalent? Do we need to rotate away from those? In determining risk, the cash flow requirements of each crop are very important. What is all this going to cost? Is it going to take a truckload of cash, and are we going to get a truckload back? Hopefully a truckload and a half. We needed to consider the direct crop production inputs, the fixed costs, the overhead and financing costs, the timing of expenses and installments for cash flow purposes, year-over-year growth or erosion, cash reserves. Are our lines of credit intact and sufficient? And regarding the insurance fork in the road, do we transfer risk or do we retain it? University of Delaware Extension has researched the costs of growing various crops. This is one example. The UD crop budget for processing baby lima beans includes total variable costs, such as seed, fertilizer, chemicals, etc., of $290. Total fixed costs would be about $269. Fixed costs are an area which can vary widely from producer to producer. In this scenario, the total cash cost would be about $560. Expected returns, which we'll see in the next slide, would be about $700 based on a price of 28 cents a pound and a yield of 2,500 pounds. So the net available for rent or land payment or return on land investment would be $139. This slide shows the expected returns at levels of price and yield. The previous slide was at 28 cents at 2,500 pounds, which gave us the $139 return after all variable and fixed costs were paid. However, the bottom line shows the results if we have a short crop, and a poor crop of 1,500 pounds is not unusual for lima beans in Delaware and on Delmarva. The negative values resulting from a potentially poor crop are why considering risk management through crop yield or revenue insurance is important. And this consideration needs to be made for each crop that we grow. So we consider crop or revenue insurance to transfer risk, just like health insurance, auto insurance, homeowners insurance. And why do we not self-insure or opt not to take insurance? Well, we do for a point. But what level is prudent for our business? In many aspects of life, we transfer the effects of risk through insurance to someone else who's willing to assume part of that risk for a fee. And that's called the premium. That's how insurance works. If we don't transfer enough risk, we might face crisis management. In Delaware and on Delmarva, coverage options include the traditional yield protection, revenue protection, which on some crops provides a price protection component as well as yield protection, and then an emerging product called whole farm revenue protection. Producers should consider a possible combination of all three, and it might be less expensive than you think. This slide indicates that since the year 2000, Delaware producers have shown an appreciation for crop insurance coverage at higher levels of coverage, from 65% all the way up to 85%. Almost 83% of the policies sold in 2017 were at these higher levels, compared to a much lower level in the year 2000. Is crop insurance actually working in Delaware? Well, we don't buy crop insurance hoping to collect a loss claim, but in the years 2001 through 16, Delaware loss payments have been $1.82 for each dollar in farmer-paid premium, and some years have been extreme, such as 2002. In that year, $9.54 were returned for every dollar in farmer-paid premium. Delaware crops for which individual insurance is available include grains and soybeans. For those, both yield protection and revenue protection are available. Yield protection is available for processing crops, many processing crops, and potatoes. Nursery production has its own insurance policy. Other crops can be insured through a written agreement. Grains and soybeans can be covered by either yield protection or revenue protection at a coverage level, a percentage of the actual production history, ranging from 50% to 85%. This chart shows at the various coverage levels what the premium subsidy is from USDA and what the farmer's premium share is. This chart shows the same for coverage of processing sweet corn, which can also be covered up to 85%. Interestingly, green peas and processing beans are crops that can only be covered up to 75%. The other component to coverage is the price election. A producer can select 100% of the established price or contract price, depending upon the provisions, or a percentage thereof. Most producers select 100% of the available price. Price selection for grains and soybeans are based upon an index based upon the Chicago Board of Trade at a certain time in the year. For instance, the base contract for soybeans is based on the January contract. Whole farm revenue protection is an emerging product which farmers should investigate. It can provide an umbrella of coverage over a wide array of production, all types of commodities, both insurable and non-insurable, individually. Many of the non-insurable crops grown here are high revenue and high input, making them very high risk. A lot of these crops can represent a very high percentage of a farm's revenue, so a loss on these particular crops can be very damaging to an operation. Producers who should consider whole farm revenue protection are those who produce otherwise non-insurable crops, a mixture of insurable and non-insurable crops, some livestock, direct marketing, or greenhouse and nursery production. Whole farm coverage can be obtained up to $8.5 million of revenue. A farm or a ranch may have up to $1 million in expected revenue from animals or animal crops, can have up to $1 million in expected revenue from greenhouse or nursery production. Not more than 50% of the revenue can be from commodities purchased for resale. And if potatoes are grown on the farm must have at least two commodities. Whole farm revenue protection can provide a layered approach to risk management. It can provide a wraparound or umbrella policy while we still insure our individually insurable crops. Get the facts and ask questions before you talk to your agent. You can contact us at decrophelp@gmail.com or call 302-242-8806.